what I'm trying to say here, that 6,000 forecast by 2029, in my opinion, is very conservative. Am I saying gold is going a lot higher? Well, nothing in life is certain, but if things remain the same, if central banks keep moving away from the dollar, and I don't see any reason why they wouldn't, it's very probable. And it's not just central banks, as I said earlier, it's also big investors.
World Gold Council data indicate that investment flows have driven the rally, primarily due to concerns that Trump's tariffs will significantly impact the global economy and lead to inflation in the United States. The WGC reported that total gold investment flow soared by 170% during the first quarter of 2025 compared to the same period 1 year prior, reaching 552 tons. This is the highest level since the first 3 months of 2022. Financial analyst Mario Innecco emphasizes the ongoing global shift away from the US dollar and toward gold as a true monetary anchor. He cites JP Morgan's estimate that just a 0.5% shift of foreign-held US assets into gold could drive prices to $6,000 by 2029. Gold's bull run will not end until investor psychology changes and the mom and pop investor piles in. Current retail demand is mainly driven by Asian investors, while US and European investors are nowhere to be seen. As well, global family office allocations to gold and precious metals is just 2%. Looking at fundamentals, Innecco challenges the $6,000 gold forecast, asking what happens if 5% of dollar reserves shift. He cites Goldman Sachs data showing that central banks quietly buy 80 tons of gold each month. An HSBC survey found over a third of central banks plan to increase gold holdings in 2025, with none selling. Central banks worldwide are on track to buy 1,000 metric tons of gold in 2025, marking their fourth consecutive year of significant purchases as they diversify their reserves from dollar-denominated assets into bullion. According to Innecco, even small shifts from the dollar can move gold sharply. He notes that gold once comprised 40% of global central bank reserves in the 1980s, and sees a return to that level as plausible, citing recent buying by former sellers, such as Kazakhstan. Before we dive into Mario Innecco's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market.
We're going to look at a couple of articles today that shows me that the move into gold as a substitute for the dollar is anything but over. Of course, the dollar, the currency, historically was the substitute for for gold, because gold has been money and always will be money, and the currency is just like a representation. It's a promissory note for that money. Of course, things have been turned upside down. And the first article I want to bring up is this one. And I saw someone post yesterday on X, I think it was Bob Coleman at Profits Plus ID on X. And he said, according to JP Morgan, shifting just 0.5% of foreign held US assets into gold in the coming years could be enough to push gold to $6,000 per troy ounce by 2029. And I retweeted that with a comment on top. I said, that's just 0.5%. What if it rises to 5%, right? 10 times. You can figure out that it's going to be a lot higher than 6,000. And he's talking about central banks. He's not talking about investors in general. So let's quickly go through the article where he took that 0.5% from. And it's from AIinvest.com. I hadn't seen that website before. I'm going to put a link to the article below in the description. You can read it. It says gold could reach 6,000 level and central banks will be the hidden force driving the rally. In this historic bull market for gold, the gold buying spree by central banks worldwide has undoubtedly become a key driving force behind the rising gold prices. although the true scale of the purchases by central bank moms remains a mystery. Few industry insiders believe they will stop in the future. According to the estimates by Goldman Sachs analysts, global central banks are currently increasing their gold holdings by approximately 80 tons per month, equivalent to about $8.5 billion at current prices. So this article is from June 4th, so from yesterday. Most of the purchases are conducted secretly and privately. Data from the World Gold Council leads to a similar conclusion. Central banks and sovereign wealth funds collectively sweep up about 1,000 tons of gold annually. Well, yeah, they've been doing that since 2022. Accounting for at least a quarter of the world's yearly gold production, a January survey by HSBC of 72 central banks showed that over a third of the respondents plan to buy more gold in 2025, with none intending to sell. During periods of geopolitical tension, gold often plays the role of a safe haven. Although this buying wave began before former US President Donald Trump launched a global trade war, it highlights the growing, I'm not sure why they say former US president, he's the president right now, but anyway, the growing concerns of some countries about over-reliance on the world's dominant reserve currency, the US dollar. The scorching rally in gold prices over the past few years has only further enhanced the metal's appeal. One of the most representative examples is the National Bank of Kazakhstan, which was one of the largest gold sellers among global central banks last year. However, according to its governor, Timur Suleymanov, the bank has now returned to being a net buyer this year and plans to continue increasing reserves. A shortcut to $6,000 gold? For Goldman Sachs, the belief that central banks' gold buying spree will continue is a major reason the firm maintains its year-end price target of $3,700 per ounce. As of Wednesday, in Asian trading, spot gold was hovering around $3,365, not far from its all-time peak of $3,500 reached in April. I'm going to skip here to the end, to the important part. You can read the rest. I'm going to put the link, of course, below. According to JP Morgan, shifting just 0.5% of foreign-held U.S. assets into gold in the coming years could be enough to push gold to $6,000 per ounce by 2029. E.V. Hambro, global head of thematic and sector investing at BlackRock, thinks the gold market is large, but the dollar market is even larger. Even a small shift of funds from the dollar market into gold could have a massive impact. So, as to my response of the 5% instead of 0.5%, you might think, well, that's too much. But thankfully, I got some data for you here. World Central Bank reserves in US dollars, gold reserves as a percentage of total reserves. So here, JP Morgan is saying if central banks shift just 0.5% of their dollar reserves into gold, it would drive gold to 6,000. But we can see here that until like the late 80s, central banks kept almost roughly 40% of their reserves in gold. By the year 2000 and since the beginning of the century, it has been more around just above 10%. And you can see that it's rising. It's still below 20%. And back in 1980, of course, that was over 60%. That was because of the gold price rising so quickly. But it could very easily go up to 40%. And that's more than just 0.5%, right? So what I'm trying to say here, that 6,000 forecast by 2029, in my opinion, is very conservative. Am I saying gold is going a lot higher? Well, nothing in life is certain, but if things remain the same, if central banks keep moving away.
While discussing a Financial Times article, Mario Innecco reveals how major institutional investors are pulling back from U.S. markets due to rising debt and Trump's unpredictable trade policies. He underscores that this shift marks a historic moment, with global portfolios increasingly diversifying away from American assets. Innecco warns that declining demand for the dollar may lead to more currency debasement and rising prices. U.S. debt has been top of mind lately, as a Republican budget bill moving through Congress is expected to add trillions to the budget deficit in the coming years. That's jolted Treasury yields, and weak demand at a 20-year bond auction earlier this month exacerbated fears that investors won't have an appetite big enough for all the red ink coming soon. In fact, Deutsche Bank warned there's a buyer's strike among foreign investors, who are no longer willing to finance massive U.S. fiscal and trade deficits. Falling demand for U.S. dollar-denominated assets is expected to push the greenback lower in the coming months, according to FX strategists surveyed by Reuters, as concerns mount about the U.S. federal deficit and debt. Let's get back to the interview.
I just saw an article that was published by the FT. Article says big investors shift away from U.S. markets. Donald Trump's trade war and rapidly mounting government debt have shaken confidence in American assets. Big institutional investors are shifting away from U.S. markets as Donald Trump's trade wars and the country's escalating debt fuel fears about dominance of American assets in global portfolios. The U.S. president's erratic trade policy has shaken global markets in recent months, sparking a sharp sell-off in the U.S. dollar and leaving Wall Street stocks lagging far behind European rivals this year. Trump's landmark tax bill, which is forecast to add $2.4 trillion to Washington's debt over the next decade, has also increased pressure on U.S. Treasuries. People need to rethink their exposures to the U.S., said Seth Bernstein, chief executive of AllianceBernstein, which manages $780 billion in assets. The deficit has been out there as an issue. It's just getting worse, he added. I think it's untenable for the United States to continue borrowing at the pace it's borrowing. When you couple that with what's going on with unpredictability of our trade policy, it should cause people to pause and consider, how much do you want concentrated in one market? A top executive at an American private capital firm described Trump's so-called Liberation Day, when the president unveiled sweeping tariffs on Washington's trading partners, as a wake-up call to a lot of people that they were overweight the U.S. As institutional investors review the extent of their holdings in the U.S., Caisse de dépôt et placement du Québec, Canada's second largest pension fund, said recently it would reduce exposure to the country, currently 40% of its portfolio. It plans to increase investment in the UK, France, and Germany. And this is what is sad here. It says the US has been the best place in the world to invest for a century. So this is really historic, in my opinion. But I'm starting to hear investors question whether U.S. exceptionalism is a little less exceptional, and think about whether to position their portfolios accordingly. This was Howard Marks, co-founder of the $203 billion alternatives manager, Oaktree Capital Management, told the Financial Times. So I'm going to stop here, and my viewers in the U.S. must be asking, how does that impact us? Well, it means there's going to be less demand for the dollar. The dollar is going to be less valuable. And when a currency becomes less valuable, the price of everything goes up. It just means more currency debasement, higher prices. Some people call that inflation. I call it the consequence of the inflation that we've seen for the last few decades. It's the result of inflation.
With many emerging market central banks holding just 5 to 6% of reserves in gold, there is room to grow toward the global average near 20%. Gradual rebalancing toward that target could help maintain strong demand without shocking the market. Strategic demand for gold is expected to push prices to $3,700 by year-end, and possibly $6,000 by 2029. As central banks lead this monetary pivot, will Western retail investors recognize the shift in time, or will they be the last to arrive at the gold party? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.